Stop everything now and pay close attention to what I'm about to tell you. Because if you believe that the US housing market has already passed its worst, you may be completely mistaken. The numbers that just came out are not rumors, not opinions, and not the predictions of alarmist YouTubers. They are cold, official data, and they are leaving economists, banks, and investors speechless. In 2025, home sales in the United States will reach their lowest level in the last 30 years, 3 decades. This means that not even in several previous crises has the market been so stagnant for so long as it is now. And when a market of this size enters a deep stagnation, the impact is not limited to houses. It spreads throughout the entire economy. What's happening now in the American housing market is something silent, but extremely dangerous. It's not a noisy collapse like in 2008, with headlines of chain bankruptcies and prices plummeting overnight. What we're seeing is an almost total freeze. People want to buy, but they can't. People want to sell, but they don't have the courage. And when buyers and sellers freeze at the same time, the market simply stops turning. Still very high mortgage rates, prices that aren't falling fast enough, and wages that aren't keeping pace with the real cost of homes have created a scenario where the dream of home ownership is out of reach for millions of Americans. This freeze generates a domino effect. Fewer sales mean less construction. Fewer constructions mean fewer jobs. Fewer jobs mean less consumption. And less consumption is exactly the kind of thing that brings down entire economies when nobody is paying attention. The housing market is not just any sector. It's a central cog in the US economy. When that cog jams, everything starts to creak. Many people look at this scenario and ask, but if this is so serious, why haven't prices fallen aggressively yet? The answer is simple and at the same time, frightening. Because the market is stuck. Homeowners are locked into old mortgages with very low interest rates and don't want to sell to assume much higher rates. Buyers are stuck because current rates make installments unaffordable. This type of artificial equilibrium is not sustainable for long. It creates enormous, invisible pressure that only grows as the months go by. And history shows that markets rarely collapse without warning. Before the collapse, there is always a long phase of denial, followed by stagnation, followed by a correction that catches most people by surprise. Not because the signs didn't exist, but because almost no one wanted to look at them. Sales at their lowest level in 30 years are not a statistical detail. They are a flashing red alert. Now, the most dangerous thing is that there is no simple way out. If interest rates remain high, the market remains stagnant until prices are forced to fall. If rates fall too quickly, this will likely happen because something much bigger than the housing market has broken down in the economy. In both scenarios, the risk doesn't disappear. It just changes form. What we are experiencing now is a turning point. One of those moments when wrong decisions, delays, or excessive optimism can be costly. For investors, buyers, families, and even those who think they are safe because they already own a home. The American housing market is sending a clear message. The question is no longer whether something will change. The question is how and when that change will happen. And now I want to know your opinion. Do you believe we are experiencing only a long period of stagnation? Or do you think this is the beginning of a silent housing crash, one of those that are only recognized when it's too late? Leave your comment below. If this video helped you see what many people are still ignoring, like it, subscribe to the channel, and activate the notification bell. Because timely information is not a luxury, it's protection. From this point on, what truly becomes worrying is not just the record-breaking sales figures at their lowest level in 30 years, but rather the invisible mechanism that is artificially keeping the American real estate market afloat. There is a false sense of stability that deceives those who only look at price charts. The market is not healthy, it is anesthetized. And anesthetized markets don't recover on their own, they wake up in shock. Behind the scenes, banks, construction companies, and large real estate funds are already operating in defensive mode. Credit is more selective, requirements have increased, and risk appetite has drastically decreased. This creates a dangerous paradox. Even with fewer buyers, the financial system doesn't want to accelerate liquidations because it knows that a sharp drop in prices would expose deep weaknesses in balance sheets. The result is a market hampered by conflicting interests, where no one wants to be the first to give in. Another critical factor is the psychological behavior of the average homeowner. Many Americans bought their homes with extremely low interest rates between 2020 and 2021. For these people, selling now means exchanging a comfortable mortgage payment for a much heavier debt. This creates an emotional and financial block that drastically reduces supply. Fewer homes available doesn't mean market strength. It means fear of losing financial security. Meanwhile, on the buyer's side, the scenario is one of growing frustration. The math simply doesn't add up. Even with stable income, the monthly cost of financing has become prohibitive. This doesn't just affect first-time buyers. It affects families who need to relocate, workers who receive offers in other cities, and even smaller investors who previously sustained part of the market's liquidity. When mobility disappears, the economy loses dynamism. This type of prolonged stagnation usually generates silent but profound consequences. Cities begin to feel a drop in revenue. Sectors linked to renovation and maintenance slow down, and the impact spreads beyond the real estate sector. The problem ceases to be just housing. It becomes economic growth. And the most dangerous thing, the longer the market remains frozen, the more violent the adjustment tends to be when it finally happens. Economic history is clear on this point. Delayed adjustments don't disappear, they accumulate. What is at stake now is not only when prices will fall, but how and with what intensity. While the public debate still revolves around whether or not house prices will fall, there is a much greater risk being ignored: the systemic risk of market stagnation. A financial system doesn't need plummeting prices to enter a crisis. It needs liquidity. And liquidity is exactly what is disappearing from the American real estate sector. When fewer homes are sold, fewer loans are originated. Fewer loans mean lower interest rates, less capital circulating, and reduced capacity for banks to reallocate risk. This puts pressure on margins, reduces lending willingness, and creates a cycle of contraction. Small regional banks, already weakened by recent events, feel this first. Then, the impact rises up the chain. Furthermore, there is a growing distortion in the official data. Average prices still appear high because transactions mostly occur within specific market segments. Cheaper homes are practically not included in the statistics because they don't sell. More expensive homes still change hands among high-income buyers. This creates the illusion of resilience, when in reality the average market is paralyzed. Another element that is rarely discussed is the impact on rents. With fewer people able to buy, the pressure on the rental market increases. This keeps rents high, erodes disposable income, and further reduces families' ability to save. The cycle closes in a perverse way. Those who don't buy pay more rent. Those who pay more rent can't afford to buy. This scenario creates social and political tensions that are becoming more apparent. Housing ceases to be merely a financial asset and returns to being a central topic of public debate. When this happens, government interventions become more likely, and poorly calibrated interventions often generate dangerous side effects. The big question institutional investors are asking themselves now is not whether there will be a correction, but whether it will come through the market or through policy. Incentives, subsidies, forced credit programs, or regulatory changes can further distort an already fragile system. This increases uncertainty and reduces long-term investment. The American real estate market is entering a phase where decisions made in the coming months could define the next decade. This is no longer about normal cycles. It's about a structural rearrangement. Every market in prolonged stagnation inevitably moves towards a breaking point. This point is not announced. It happens when a variable changes too quickly for the system to absorb. It could be an unexpected drop in employment, an external shock, a sudden change in monetary policy, or a simple loss of collective confidence. The American real estate market is vulnerable to all of these triggers. If unemployment rises significantly, even homeowners with low interest rates may be forced to sell. If this happens on a large scale, oversupply quickly appears and puts pressure on prices. If prices start to fall, behavior changes. Fear replaces inertia, and markets driven by fear don't fall slowly. On the other hand, if rates fall rapidly in response to a broader economic slowdown, this could reignite buying, but also signal that something larger than the housing sector has entered a crisis. In this scenario, falling rates are not a solution, they are a symptom. And serious symptoms are often accompanied by side effects. There is also the quieter and perhaps more dangerous scenario: Years of stagnation, without a significant drop and without real recovery. A living dead market. In this environment, inequality increases, social mobility decreases, and the economy loses efficiency. It's not a cinematic crash. It's a slow and corrosive erosion. Regardless of the path taken, one thing is certain. The American real estate market of the past no longer exists. The rules have changed. Consumer behavior has changed. The cost of money has changed. And those who insist on analyzing this market through the lens of the past risk making costly decisions. The sales figures at their lowest level in 30 years are just the first visible chapter of a much larger story. A story that involves credit, psychology, politics, and time. Ignoring this doesn't make the problem any smaller. It only postpones the impact. The real risk now lies not in predicting exactly when something will happen, but in pretending that nothing is happening. Because when markets finally move after long periods of silence, they rarely give a second warning. There's a piece of data that rarely makes headlines, but is being closely watched by more experienced analysts. The silent increase in defaults in specific market segments. We're not talking about a widespread explosion of foreclosures like in 2008, but something more subtle, and, precisely for that reason, more dangerous. Small increases, distributed over time, in regions where growth has been more artificial in recent years. Many of these homes were purchased at the height of the post-pandemic euphoria, when inflated prices seemed normal and cheap credit created a false sense of security. Now, with higher living costs, more expensive insurance, adjusted property taxes, and squeezed incomes, some families are beginning to realize they are more vulnerable than they imagined. The problem isn't just losing the house. It's the feeling of being trapped in an asset that no longer offers protection. This type of vulnerability doesn't explode all at once. It spreads slowly, contaminating specific regions before reaching the market as a whole. When the first properties start appearing with forced discounts, the psychological effect is immediate. Buyers begin to expect lower prices. Sellers become defensive. Volume stalls even further, and the cycle deepens. Another critical sign comes from the behavior of large construction companies. Publicly, the speeches are still cautious and optimistic, but internally, the focus has changed. The objective has shifted from aggressive expansion to cash preservation. Projects are postponed, launches reduced, and future investments reevaluated with extreme care. This happens because construction companies depend on turnover. They need to sell to continue building. When sales slow down for too long, the risk increases exponentially. Expensive land purchases become liabilities. Unsold inventory puts pressure on margins. And any miscalculation can compromise entire balance sheets. This defensive behavior directly affects the local economy. Fewer construction projects mean fewer jobs, less consumption, and less tax revenue. The impact doesn't immediately appear in national data, but it begins to be felt in specific communities. And economic crises rarely start out large. They begin regionally. For years, investors were responsible for a significant portion of residential property purchases in the United States. Small, medium, and large investors helped sustain prices and liquidity. Today, many of them have simply disappeared from the market, not because they lost interest in real estate, but because the risk no longer pays off. With high interest rates, politically pressured rents, and rising operating costs, risk-adjusted returns have decreased dramatically. Experienced investors know when a market enters a phase of negative asymmetry, and when that happens, they pull back. The absence of investors creates a void that is difficult to fill. Traditional buyers cannot absorb this demand, and without this support, the market loses an important layer of stability. The result is yet another factor of structural fragility. Whenever positive data emerges, such as a month of slight sales growth or a small drop in interest rates, a narrative of recovery arises. But that is precisely where the danger lies. Technical recoveries do not signify structural reversal. They often serve only to delay inevitable adjustments. When the market reacts briefly and then weakens again, frustration increases. Buyers who entered believing the market had bottomed out feel cheated. Sellers lose confidence, and the market stalls again, but now with less hope. This pattern erodes collective sentiment and creates an environment of prolonged uncertainty. And markets hate uncertainty. When no one can clearly project the future, decisions are postponed indefinitely. There is a profound demographic shift happening. Young adults, Even those with education and jobs are being pushed out of the housing market. The result is not just economic, it's cultural. Home ownership has always been a central part of the American dream. When that dream becomes unattainable, the psychological impact is enormous. This generation consumes differently, invests differently, and thinks about the future in a more defensive way. This alters long-term patterns. Fewer large purchases, less family stability, less community roots. All of this has direct repercussions on the real estate market and the economy as a whole. Ignoring this factor is to underestimate the size of the problem. As the affordability crisis deepens, the real estate market definitively enters the political arena. Proposals for control, subsidies, taxes, and restrictions emerge with greater force. Some help, others worsen the situation. But all increase uncertainty. When investors and construction companies don't know what rules will apply tomorrow, they reduce their exposure today. This slows the market even further. The risk ceases to be purely economic and becomes regulatory. And regulatory risk is one of the most difficult to price in. Perhaps the most unsettling aspect of this whole scenario is the silence. There is no widespread panic. There are no sensational headlines every day. There are only cold data, defensive decisions, and a market that seems stuck in time. But economic history teaches a clear lesson. Major movements usually come after long periods of stillness. The American real estate market is exactly at that point. It's no longer a question of whether something will happen. It's about what trigger will break the equilibrium. And when that happens, the movement tends to be rapid, because many will be looking back while the market has already changed direction.